this point, it's trying to have this Goldilocks scenario, as we know, and the outlook, of course, was that the Fed's going to look to be cutting rates because they see a soft landing approaching, and it looks like on the surface it is. I mean, you see the numbers that you just described in terms of Friday's job report. You see inflation slowing over the last number of months. But at the same time, underneath the surface, you're seeing a lot of cracks. I mean, you're seeing cracks in terms of the consumer. You're seeing cracks in terms of the global economy with China, with other inflation numbers around the world. So it looks like the U.S. is the best spot to be in. And I think today that's true, except I think it's that forward path as, are we going to see things start to fall off a cliff, or are we going to sort of glide path down and corporate earnings are going to be sheltered from the storm? That's the thing I think people don't have a really good understanding of today, but they're believing that that's going to happen. That's the narrative.
David, as you talk about cracks, then where does this leave the oil position? Because we know that last week energy was again a move to the south, 3.8% coming off WTI Brent. I can see you're still positioned in some small energy cap stocks. Is that the right positioning, given that the market is now concerned around the demand story impacting oil?
Well, it's a tough positioning. I think first, small caps have greatly underperformed large cap, mega cap. Like you said, 2023 was all about the mega cap, the Mag 7, right? And those are the biggest companies of the world. Some of them have the strongest balance sheets in the world. There's obviously a viewpoint on AI and the growth there and the dynamics there around earnings and what potentially could be for companies going forward. But at the same time, what's the market telling you? I mean, we're talking about strong numbers on Friday, and there's a soft landing, and the U.S. is great. But then, when you look at the oil market and you look at the gold market, two areas that Livermore is invested in, I mean, oil down around 70 WTI and gold at $2,000 an ounce is telling a whole different story. Central banks are increasing their gold reserves, 100 metric tons. There's something going on there. I think a lot of it has to do when you look at government spend over the last several years as well. We've had $7 trillion of QE in the markets for a number of years. We have debt to GDP for the U.S. economy at over 120%. China's is off the charts as well. So there's these totally different dynamics going on. And then you have China slowing. So when you look at the oil, like I said, and you look at the gold market, that's telling you recession is in the front. But when you read the tea leaves in terms of what analysts are saying, economists are saying as far as the U.S. economy, that the soft landing is approaching, and that's what actually the 10-year is telling you. There's somebody has it wrong here, is what I'm trying to tell you. Somebody has it wrong. It's hard to describe who has it yet. So I'm just really waiting and seeing and trying to decipher what's the right path to take.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.